Hi, my name is Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this week's supply and demand, Forex and gold and S&P fundamental and technical analysis for the week ahead starting the 5th of January. I hope you all had a great Christmas and New Year's. And so the market now should really be returning back to some sort of normality as traders come back from the Christmas break. And so let's get into the calendar for next week. So yeah, Monday we've got the bank services PMI for the yen. I think his services PMI is something definitely key to watch, as it's seen as a bit of a leading indicator for GDP. We've also got services PMI for the euro area, and services PMI for the UK, and for the US as well. So those should definitely be watched. Tuesday, inflation rate year on year for the Swiss franc. I think that's definitely going to be something. If you're trading the Swiss franc, the forecast is expected to be a lot, actually I say a lot higher, but 1% from 7%, 0.7%. But we'll see what happens there. Inflation rate year on year, and unemployment rate for the euro area, as well as core inflation rate and inflation rate month on month, are definitely going to be very important for the European Central Bank. That will likely confirm what the European Central Bank's plans are for interest rates. It looks like the consensus is for actually slightly higher. The previous was 2.2 and inflation 2.4. So maybe rising inflation. And we'll get into maybe some potential rising inflation a bit later when it comes to not only Europe, but other currencies as well, in terms of energy prices rising. Then we've got Canada IV PMIs, the US services PMIs again, and the JOLTS job openings. So employment. Then for the Australian dollar, we've got CPI, monthly CPI indicator, and again, it looks like inflation forecasted to go higher. Then we've got ADP employment change. Fed's Waller speech. Now, speeches can have an effect on the currency depending on how hawkish or dovish they are. And then we've got FOMC minutes on Wednesday. Thursday, we've got initial jobs claim, and then we've got a bunch of speakers from the US. And then Friday, we have the unemployment rate for the Swiss franc, and we have unemployment rate and the employment change for Canada, as well as the blockbuster non-farm payrolls the first Friday of every month, and unemployment rate, average hourly earnings, which is inflationary. So yeah, those are what I would consider to be more of the market moving news for the week. So starting off on the dollar index, equally weighted dollar index, and again, this is just really an overall measure of dollar strength against various currencies, equally weighted. So if you look at the top left hand side, we've got the dollar versus the euro, dollar versus pound, dollar versus the yen, CAD, Australian dollar, New Zealand dollar, and the Swiss franc. And so this is more of a it's different from the DXY or the USDX in terms of it's equally weighted, and it's weighted against different currencies in terms of it's weighted against currencies that we trade. And I think it's a more accurate way to use the dollar index, although they are similar. But if you do want to add these to your trading view charts, I'll leave it the link on the top right hand side of the screen, or in the description box below. So the dollar index for me, the dollar overall should really be a buy. So really just a pull back into a level of demand somewhere around here before looking at going long on any dollar crosses, right? And from a fundamental perspective, it says here dollar gains as Fed rate cut rethinks fuels best year in 9. So the Fed's slower pace of interest rate cuts to aid the dollar, and many Trump policies will be dollar bullish early 2025, says TD. And so yeah, the because the Donald Trump's policies are seen as being inflationary. If inflation starts to rise again beyond that 2%, their 2% target, and stays elevated above that, then there's less need to cut rates. Cutting rates is supposed to have the effect of devaluing a currency, and rising inflation actually is a currency weakening. So you don't want to cut rates and weaken the currency when inflation is rising, and rising inflation means the currency is devaluing. In fact, you have to hike rates and do the opposite. You have to strengthen your currency, hike rates in order to combat inflation. So if inflation continues to rise or starts rising, then really, in fact, we could see the Fed return to a policy of hikes again, depending on, of course, what happens with inflation. So it says here the US dollar rose Tuesday, capping its strongest yearly advance in nearly a decade as the solid US economy and President-elect Donald Trump tax cuts and tariff policies promised to keep interest rates elevated. The gain drove the Bloomberg Dollar Spot Index to the highest since November 2022. It has risen 8% this year, the most since 2015, after the surprisingly resilient expansion drove traders to dial back expectations for how much the Federal Reserve will ease monetary policy. Analysts have indicated that the dollar rally has room to continue into early next year after Fed officials signal caution about further interest rate reductions, breaking with other central banks that are expected to dial back rates more quickly. That's given investors an incentive to shift cash into the US, which has pushed up the currency. And it says here, finally, a group of market players, including hedge funds and asset managers, have increased aggregate bets on the dollar's rise to some 29.8 billion, according to data compiled by Bloomberg. That's the most bullish positioning towards the US currency since April. So you can see here, speculators steady. Let's zoom in a little bit. It says here, speculators steadily boosting bullish dollar wages, right? So you can see pretty much this is the highest in terms of aggregate dollar positions and non-commercial traders, right? So the big money are also looking to buy the dollar. Now, does that mean that looking at a price chart you should go long now? Me personally, I would say no. I would always look for a pullback to buy for cheaper. So if, the dollar pulls back to around here, then I'm looking at buy trades if there is obviously the dollar and nothing changes fundamentally, right? Or if prices pull back down here, because this does look like the dollar does need a bit more of a deeper pullback, to be fair. But of course, who knows? Also, as well, in terms of the seasonality, right, and for the euro dollar and really the dollar kind of strengthening, we really have a negative euro bias heading into weeks 2 and 9, and this is basically uh, seasonal performance of the euro since 1999. So for the last 25 years, 26 years, maybe going into that. So euro, from a euro dollar perspective, meaning the euro tends to weaken in the first, 2 to 9 weeks. Typically, that means the dollar should strengthen, right? And so, from a seasonal perspective, we could see some more dollar strength. So, ultimately, any pullbacks, I think, on the on the dollar is really just buying opportunities. So if it does happen, right? Moving on to the dollar yen, and the yen, again, a bit of a tricky one, but I think I've got more of a mixed view on the yen. It says here, yen bulls retreat as hopes fade for fast cut in rate gap. So leverage funds were most bearish on the yen since July's CFTC report, and Mitsui's Sumitomo Insurance recently cut their forecast. So traders are trimming their bets on a yen rally after policy meetings from the Federal Reserve and Bank of Japan cast doubt on how quickly the rate differentials between the US and Japan may narrow. So I guess one second, I'll just bring up this tool. So what we're trying to do really in terms of understanding the fundamentals, or the basic fundamentals, is understanding convergences and divergences. So let's say, for example, the dollar has, I think it's about 5% on their interest rate, right? And the yen, let's say, has, I think, 0.5% their interest rates. Now, what you typically want to do is buy the currency with the higher interest rate over the one with the lower interest rate, right? You would do that, normally in terms of, going to a bank, right? If you're putting your money in a bank, you want to put your money in a bank that's offering a higher interest rate than the lower yielding one, right? But when you have a situation where you're expecting that currency or the central bank that's looking to cut interest rates from a high interest rate, and the lower interest rate is looking to raise interest rates, yeah, you actually want to buy this the lower currency, simply because they're looking to appreciate their currency, and these guys are looking to actively devalue their currency by cutting rates. And that should actually, if this was the dollar and this was the yen, right? This is the yen. Then on the dollar yen pair, you actually want to look for short trades, right? But this scenario is being cast into doubt, right? And as to how quickly those differentials between the US and Japan may narrow, right? So at the moment, it now looks like the Federal Reserve may not cut as aggressively as first thought, and also the Bank of Japan may not hike as aggressively as first thought. So now the market has to kind of price out what it kind of thought was going to be maybe dollar yen short. So maybe you have to price in a bit more dollar strength, right? Because at the end of the day, um it's the buy the rumor needs the data to support the rumor. If the data is not supporting that rumor, then unfortunately that rumor won't come true, and then things kind of fall apart. Anyways, prior to the back-to-back meetings last week, strategists were betting that 2025 would be the year for the yen, but the market is now feeling less optimistic on the yen's outlook after Bank of Japan Governor Kazuo Ueda opened up the possibility of waiting longer for the next hike, while the Fed signaled a slowdown in the pace of monetary easing next year. Yeah. So options metrics suggest that traders were the least bullish on the yen in a month after the meetings. Leverage funds also raised their net short position on the yen to some 44,926 contracts, the most since July, just before macro volatility roiled global currency markets, according to the latest Commodity Futures Trading Commission data for the week ended December the 17th. So this is the leverage funds most bearish on the yen since July, right? So you can see it right here. This is 2024, and now they're the most bearish since July, which was probably halfway through the year, right? So or maybe around there, who knows? But ultimately, the yen is running out of a bit of steam in terms of the the bulls. And so what does that mean for the dollar yen? Looks like if that continues, really you're looking at more higher highs. Now again, don't know whether it's gonna no one knows whether it's gonna reverse here, or even reverse here, or even pull back, right? No one knows. But what we're looking for is an if then scenario. If prices pull back to these areas, then I will look to take a trade of some sort, right? So if of course there is an entry, but that's really what I'm looking for in terms of the direction of travel. I think the dollar yen should really make higher highs. Dollar Swiss should again make more highs. The Swiss franc really isn't a currency to buy just yet. Although there is inflation news coming out, I think they do want a weaker Swiss franc in terms of the Swiss National Bank, and so they'll do whatever they can to weaken their Swiss franc. So especially if the data comes out and doesn't support the fact that the Swiss inflation is moving back towards their 2% target. So yeah, for me, if there is a pullback, I'd really want more buys around this area here. In terms of the dollar Swiss, dollar CAD, I think the dollar CAD should again also be a buy. In terms of the tariff trade war potential from Donald Trump affecting not only the Chinese economy, also as well, Donald Trump has made comments in terms of raising tariffs on Canadian goods as well as Europe. So the dollar is really in the driving seat at the moment. So any pullbacks, I think, into this area here, or if prices make higher highs and then a pullback into that area there, I think that's going to be a really nice buy trade in terms of buying the dollar CAD. But again, what you really want to see is before you start entering into any dollar trades is going back to the dollar index and looking to see if the dollar is on the cheaper side, right? That would be like the extra confluence. I don't really like buying for cheaper if the dollar index is still on the expensive side. So that's really the confluence that I look towards whenever I'm taking a trade. Pound dollar. So the pound dollar, I think, should be more of a sell than a buy. It's definitely on my watch list in terms of now, anyway, looking for sell trades. The Bank of England are looking to cut rates this year. But also, when it comes to the UK economy, there are risks on the horizon. So it says here dollar strength versus the pound and the euro fueled by higher oil and gas prices. So it says here the euro and British pound slumped against the dollar at the start of the year, with some analysts concluding that rising energy costs are playing a significant role. And so Brent crude has risen while natural gas prices have doubled, right? And this is pointing to rising cost pressures facing the UK and European businesses, according to Jeremy Bolton, the Reuters market analyst. This dynamic favors the dollar, which is the currency of the world's biggest or the largest exporter of both oil and gas. And so the surge in gas prices is meanwhile particularly problematic for the eurozone and the UK. And it says here that it says the pound was one of the worst performing G10 currencies. An opening day at one stage, with fears over growth in Europe remaining a key focus for investors. The UK wholesale gas prices rose on January 2nd, the highest level recorded since January 2023. The UK is facing an economic crisis as rising gas prices are added to a bevy of cost pressures that include the year's impending hikes in minimum wages and employer tax increases. So, if rising energy prices for both Europe and the UK start to take effect, then that could really affect the economy in terms of people spending, businesses. And so we could see actually a situation where we get stagflation, which is where you have central banks rising energy prices actually causes inflation to rise. But at the same time, you have GDP, which may continue to contract because of the effect of these gas prices on households and businesses. And so that's what's known when you have rising inflation, right? Rising inflation, but a contracting economy. That's what's known as stagflation. And so stagflation is really one of central banks' worst nightmares, because they don't want to cut rates in this environment, because otherwise they could contribute to rising inflation, which is basically, if they're mandated to get inflation down to that 2% target, that's the wrong thing to do. They're doing the opposite. They're putting fuel on the fire of inflation rather than trying to get it down. So ultimately they have to end up, if inflation starts to rise, they have to actually cut rates. So they have to hike rates, right? They have to hike rates if inflation is rising. But at the same time, if they hike rates, then that hurts the economy because of businesses borrowing and lending. Mortgages, for example, the cost of mortgages going higher, so that hurts the economy. So the central bank is in a bit of a bind when it comes to stagflation. So very, very tricky times for both Europe and the UK. So, when you look at that and you look at, the dollar, and the situation around the dollar, it looks like just continued sells really, because the US economy is doing pretty decent. Then they're not really looking at any kind of stagflation scenario, right? And so, really, I think the path of least resistance should be really if prices pull back into this supply zone before looking at going short. And for anyone, by the way, who is looking to join the Trading 180 Discord group mentorship, the enrollment starts on the 6th of January, and for a short time, it'll only be open for about 5 days until the next opening, which may be around March or April. And so if you have been waiting, it will open up tomorrow, and not only do you get expert analysis, you get access to the fundamental analysis spreadsheet as well, which has been really a guiding light for all traders who use it. It gives us really our bias, or at least a definite starting point when it comes to which currencies are the strongest versus the weakest. So on currently, we've got the US ranked as number one based on the data that we look at, and New Zealand actually is number 8, and the euro area is number 7, right? And also as well, you get access to the Discord room and the group, and a bunch of great traders in here, very supportive traders, as well as really so much more. But also as well, the trading videos channel, which is basically all of the in-depth analysis that I don't put on YouTube, all the webinars. And I have a weekly webinar as well, live webinar, where you guys can basically join a live Zoom call and ask me questions, and we go over the market, and that's recorded as well and put into the this trading videos channel. And by the way, I have years and years of videos all here for you to watch. Also as well, for the members who are in the Discord group, this is the members video, weekly video. So you've got the members weekly fundamental channel here, or video here, and then you also have the fundamental channel as well, the fundamental videos. So click on those, and those will be way more detailed than what you're seeing here on YouTube. So and I cover pretty much all of the currencies. So again, supply and demand and fundamental and mentoring opens up tomorrow. So go to trading180.com if you have been waiting to join. So getting back really to the chart, and we have pound yen, and again the pound yen for me, not really a pair that I'm looking to trade at the moment. I think there are definitely a lot of risks, but if you are looking to buy, then I think now is a decent time to look for buy trades. If you're looking for short trades, then you may want to wait for prices to kind of pull back to these highs. Now, this level has been touched several times, so you've got a level that's been touched once, twice, 3 times. And the rule of thumb is that the more times a level is touched, the weaker it becomes. So if it does, prices do pull back up here, you could actually see a bit more or a bit of a stop hunt before prices do move to the downside. If you're thinking that the yen should strengthen over the pound, if you're looking at buying the pound over the yen, then of course you're looking for either a trade now if you see an entry, or a bit more of a pullback for looking at going long. Looking at the dollar index, sorry, the euro index, and the euro index, again, just like the dollar index, it compares the euro with all of the currencies that we trade. So you're looking at the pound, the euro, the CAD, the Australian dollar, the Swiss franc, the New Zealand dollar, right? And this is the euro strength against all of those currencies. So if you're looking to sell the euro, which I am, short the euro, then you're looking really for a bit more of a pullback before going short. And I want to see it pull back a bit more before looking at going short on any euro crosses. And so I think overall, we kind of looked at the dollar strength against the euro, and basically the same scenario that is happening with the UK in terms of rising energy prices is also uh, likely to affect Europe, right? So he says here this the gas prices rising will increase pressure on Germany's already struggling domestic industrial base. And Germany is really Europe's economic engine, and so we also have the ECB hopes to hit 2% inflation target in 2025. Christine Lagarde says, and really the key for this is that it says still that slowdown allowed policymakers to cut interest rates in 4 quarter point moves, and economists predict another 4 reductions through June. So it does look like the European Central Bank is looking to still continue to cut 4 times, whereas really the US have really not. I think they're looking to hold rates a lot longer. So if we're looking at and going to the euro dollar, if that does, again, the data does support that narrative, then really any pullbacks into a supply zone, whether it's there or whether you see prices move a bit higher, should really be shorting opportunities, in my opinion. No reason to look for long trades. No one even knows if prices are really going to bounce from here, right? So there is obviously the target of parity, so it could actually reach parity before it even pulls back. So parity is around here, so this demand zone here. So let's see, we've got another maybe 300 pips before there is parity. Hopefully we can get a pullback on the euro dollar before looking at going short, and then just kind of hold if things get worse in Europe and things get better in the US. Looking at the euro yen, again, not really a pair that I'm interested in. But if you are, then a bit more of a pullback into a nice demand zone before looking at going long, it would be really the advised move. If you're looking to buy the euro, then you're looking for really a pullback up into this supply zone here. And in fact, supply would be starting from there. Yeah, so that's where you're looking at in terms of supply. And again, just keep in mind that this level's been touched, once, twice, and so we could see prices move through that area before putting back down if you are looking to buy the yen versus the euro. Euro pound, I still think the pound has a bit more of an advantage over the eurozone. So my bias would be more to look for some short trades. And again, this level's been touched several times. If you look at here, once, twice, 3 times. So I'm of the opinion that if you're looking to buy the pound over the euro, above that area could be a really nice stop hunt. If not, you're looking at really a short trade around this supply zone, the 0.835s to 0.8375. So that would be, for me, the direction of travel for the euro pound. Aussie dollar. So although I'm a bit more bullish on the or a bit bullish on the Australian dollar, not really against the US dollar. I think the US dollar does have an advantage when it comes to the risk sentiment. Right, let me just zoom out a little bit. Yeah, it doesn't look like. I guess we'd have to maybe draw the demand zone somewhere all the way down here. But yeah, I think we will see more downside potential. And again, reason being is because Trump tariffs and Trump policies are really a negative on China, or a potential negative on China. And so if and their economy, and if China's economy starts to contract, then that also hurts uh, Australian exports, like commodities like gold, iron ore, because the Chinese are going to be less likely to invest in infrastructure projects, meaning that they're going to import less, of those commodities like copper for infrastructure projects. Therefore, if Australia sell less, then it's going to hurt their bottom line, and it's going to hurt their economy, right? Or at least contract their economy. So, yeah, I do think that the Australian dollar, although I think it's more of a buy against other currencies, for example, I'd buy it more against the euro. I wouldn't necessarily buy it against the US dollar. So I think any pullbacks should be decent selling opportunities if you're looking at trading this pair, either there, or if it pulls back a bit more, then at least the underside of that supply zone there. Looking at gold, again, gold is a bit of a mixed bag in terms of the fundamentals. There's reasons to buy gold and there's reasons to sell gold. Any kind of risk off scenario should really be gold buy, but at the same time, you've got the backdrop of the dollar looking to strengthen, and when the dollar strengthens, typically, usually you have gold actually selling off. So yeah, gold, I think overall long term is always a buy. But in terms of trading it right now, I do think it does look like the probabilities are more downside. But of course, if the fundamentals aren't clear, then the thing is just to not trade it, right? If you haven't got necessarily a clear direction of travel, I personally don't trade assets or currencies that haven't at least got I've got a decent fundamental bias. And so with gold at the moment, the way that it's looking, then fundamentally I'm not necessarily haven't got a strong conviction anyway, so I'm going to not necessarily look at gold for now. But if you are a pullback into that area, that the lower end of demand is going to be a decent technical area, and even there, and anywhere probably right now, if you get a little bit more of a pullback, could be decent for a short trade. And then looking at the S&P 500, S&P 500, I think again should be really more of a buy overall, but I think the S&P may have reached a bit of a peak. Reason being is because when you have interest rate cuts, right, and you have the economy is doing well. Actually, I should really draw that. So interest rate cuts, right, and the economy is doing well, then cheap money, right, typically fuels the S&P higher, right? But if the economy isn't, if the economy starts to contract, for example, if there's fears of maybe a recession or whatever it is, then in fact you could see a bit more of a pullback. Now, at the moment, it doesn't seem like there's any fears of a recession in the US. So I would assume that any pullbacks should be really buying opportunities, whether it pulls back to there or whether it pulled, you get a deeper pullback into here. But also as well, the fact that the Federal Reserve are not necessarily cutting aggressively could also be a factor as to why we get more of a deeper pullback. But ultimately, they still are cutting. So I would suggest, well, my bias is, again, any pullbacks, I think, into these areas should really be more buying opportunities than selling opportunities. But if anything changes in terms of, let's say, for example, there are, the Federal Reserve start to look to now hike rates, then in fact, I think the S&P could make, actually deeper pullbacks into maybe the 5.2s, 5.48s. But again, we'll have to see what happens with the data. So that's the the roundup for the week's fundamental analysis. And again, just as a reminder, the enrollment opens the 6th of January, and it'll be open until maybe the 10th or 11th of January, maybe about 4 or 5 days, the first intake, and then it won't be open again until somewhere like March or April. So if you do want to join, now's your opportunity, and I look forward to working with you. So take care, have a great trading week. I'll see you all soon.